Futures contracts are standardized agreements between two parties to buy or sell an underlying asset at a predetermined price on a specified future date. These contracts are traded on organized exchanges and may involve commodities, currencies, stock indices, interest rates, or financial securities. Futures contracts are legally binding obligations, unlike options contracts, which provide rights without obligations. Standardization is one of the most important characteristics of futures because exchanges specify contract size, delivery procedures, expiration dates, and quality standards. This standardization promotes liquidity and efficient trading. Futures are widely used for hedging, speculation, and arbitrage purposes, making them essential instruments in global financial markets and risk management activities. A key characteristic of futures markets is the role of exchanges and clearinghouses in reducing counterparty risk. The clearinghouse acts as the buyer to every seller and the seller to every buyer, guaranteeing contract performance and minimizing default risk. Traders are required to deposit initial margin when entering positions and maintain variation margin as market prices fluctuate. Futures contracts are marked to market daily, meaning gains and losses are settled each trading day rather than only at contract expiration. If account balances fall below maintenance margin requirements, traders receive margin calls requiring additional collateral. These mechanisms strengthen financial stability and distinguish futures markets from privately negotiated forward markets. Futures markets serve several critical economic functions, particularly in risk management and price discovery. Hedgers use futures contracts to protect against unfavorable price movements in underlying assets. For example, farmers may hedge agricultural products against declining prices, while portfolio managers may hedge stock portfolios using index futures. Speculators participate in futures markets to profit from expected price changes and provide liquidity to other market participants. Arbitrageurs exploit temporary price discrepancies between futures and spot markets, helping maintain pricing efficiency. Through continuous trading activity, futures markets incorporate information rapidly into prices, making them important mechanisms for forecasting market expectations and allocating risk efficiently across the financial system. Futures positions can be classified as either long or short depending on the trader's expectations and objectives. A long futures position obligates the trader to purchase the underlying asset in the future and generally benefits from rising prices. A short futures position obligates the trader to deliver or sell the underlying asset and benefits when prices decline. Hedgers often use short hedges to protect against falling asset prices and long hedges to protect against rising purchase costs. Because futures involve leverage, traders can control large notional positions with relatively small margin deposits. While leverage increases potential returns, it also magnifies losses, making effective risk management essential for futures market participants. Futures markets are highly organized and regulated to ensure transparency, liquidity, and market integrity. Exchanges determine which contracts are available for trading and establish rules governing delivery, settlement, trading hours, and margin requirements. Trading can occur through open outcry systems or electronic trading platforms, with electronic trading now dominating most global futures markets. Market participants use various order types, including market orders, limit orders, stop-loss orders, and stop-limit orders, to manage execution strategies and control trading risk. Liquidity is generally high for actively traded futures contracts, allowing participants to enter and exit positions efficiently. The organized structure of futures markets contributes significantly to investor confidence and financial stability. The program emphasizes the importance of understanding futures characteristics and market operations because futures are central tools in modern financial risk management. Futures contracts are widely used by banks, corporations, hedge funds, pension funds, and institutional investors to hedge exposures, manage portfolio risk, and implement trading strategies. Their standardized structure, centralized clearing mechanisms, and transparent pricing make futures markets more secure and efficient than many over-the-counter alternatives. At the same time, leverage, basis risk, and market volatility can create significant exposures if positions are not managed properly. Understanding how futures markets function is therefore essential for financial risk professionals responsible for managing market, liquidity, and operational risks.